Hi guys, good morning and welcome back to another video. It's Zaneaestermarie here with Metro Brokers in Denver, Colorado. So I know buying a home is super exciting, but thinking about the financing side of it can be very overwhelming. So today we're just going to break down the 5 common types of mortgages. Let's just have a conversation. Let's just talk. Let's just learn from each other, Like, why does everything have to be so serious? So I'm just going to start by talking about a conventional mortgage. So a conventional mortgage is a mortgage that is not insured by the government. So these type of mortgages are like mortgages that you get from your bank or like a private lender or such. So there are pros and cons to every mortgage. So let's start off with the pros for a conventional mortgage. So it can be used for a primary home, a secondary home, or an investment home. Your overall borrowing costs tend to be much lower than other mortgages, even if the interest rates are higher. You can ask your lender to cancel your PMI once you've gained 20% equity on your loan. You can pay as little as 3% down on your loan if it's backed by Fannie Mae or Freddie Mac. Now the cons of a conventional loan. Minimum FICO score, which is a credit score, is 620 or higher. You must have a debt to income ratio of 45 to 50%. If your down payment is less than 20%, you most likely have to pay a PMI, which is a private mortgage insurance. A lot of documentation is required to verify your income, your assets, a down payment, and employment. Conventional loans are more ideal for people with strong credit, a stable income and employment history, and at least a 3% down payment. Jumbo mortgages are non-conforming mortgages that have a non-conforming loan limit. So to put that into simpler terms, these are mortgages that exceed the limit of a regular federal loan. So, for example, in 2020, the maximum amount for a conventional loan is $510,000 for a single family home in most of the U.S. Jumbo loans are most common in higher priced area, and they usually have to have more documentation because you are borrowing a higher amount. So the pros of a jumbo mortgage is that you can buy in more expensive areas. Interest rates tend to be competitive with the regular conventional loan. The cons of a jumbo mortgage is that about 10 to 20% of a down payment is required. A FICO score of 700 or higher is required mostly. There are some exceptions where a 660 will be accepted with some lenders. Your debt to income ratio cannot be above 45%. And you must show that you have assets that equal to about 10% of the loan in cash or in a savings account. So jumbo loans are for the people who are trying to buy a high-end home, who have an excellent credit score, a substantial down payment. Now we have government issued loans. So there are 3 main types of government issue loans. You have FHA loans, USDA loans, and VA loans. FHA is Federal Housing Administration. So this type of loan is for people who don't have a large down payment and don't have the best of a credit score. So you do need at least a 580 in order to get the maximum of 96.6 financing and also a 3.5% down payment. However, if you do have a credit score of at least 500, you can still possibly be accepted. You just have to have at least 10% for a down payment. Now we have a USDA loan. This loan is to help more low to moderate income people buy a home in a rural area. So one of the requirements for this loan is that you have to purchase a home in a USDA eligible area. And you must have a certain income limit to qualify. Now some of these loans do not require a down payment for people with a low income. The last type of government loan that we have is a VA loan. Now this is for people who are in the military and their families. Now for VA loans, you do not have to have a down payment, you don't have any PMI, and in most cases, closing costs are paid by the seller. The funding fee is charged on a VA loan as a percentage of the loan amount, just to pay the taxpayers. Pros of a government loan: they help you buy a home even when you don't qualify for a conventional loan. Most of the credit requirements are pretty relaxed. You don't need a large down payment. They are open to first-time buyers and repeat first-time buyers. So, well, I will probably get into that in another video about what I mean by repeat first-time buyers and first-time buyers. Yeah, let me know if you want to know more about that, because a lot of people don't know that you can be a first-time buyer even if it's not your first time buying a house. Interesting. Some of the cons is that you can expect to pay a higher PMI, and also you'll probably have a higher borrowing cost overall. You have to provide a little bit more documentation to prove that you are eligible. We have fixed rate mortgages. So these are mortgages that keep the same interest rate over the entire period of the loan, which basically means that your monthly mortgage payment is going to be the exact same. So these usually come in 15, 20, or 30 years. Pros of these types of mortgages are that of course that the payment of the loan stays the exact same over the entire length of the loan, and also you can budget better because you do know exactly what expenses you do have to pay for your mortgage every month. Some of the cons are that you usually pay more interest with a longer term loan. It usually takes longer to build up equity in your home, and interest rates are typically higher than rates on an adjustable rate mortgage. So if you plan to stay in your home for at least 7 to 10 years, a fixed rate mortgage offers you more stability. Now lastly, we have adjustable rate mortgages. Now these mortgages are mortgages that the interest rate can go up or down depending on what happens in the market. So the most common adjustable rates are the 5-1 and the 7-1. So meaning basically that the first 5 years you have the same interest rate, and then after that the interest rate can go up or down. And the same for a 7-1 adjustable rate. The first 7 years it'll be the same. After the 7th year it will go up and down depending on the market. What's great about this is first few years you'll have a lower rate. A lot of your money is going to go towards your interest payment. Some of the cons with this is that after the 5 or 7 years the mortgage can go up or down, meaning if it does go up, this can cost you something if you are not able to pay, meaning that your mortgage rates could possibly become unaffordable if the rates do go up, and then you'll end up defaulting on your loan, foreclosure, but we don't want to have that. So these types of loans are better for people who don't plan to stay in their home for too many years, and that way you could save a lot of money on your interest payments. Now there are a lot of other different types of loans and mortgages, but these are the 5 most common types. So I just wanted to drop in, give you a little bit of knowledge, hoping that this helps you understand a little bit more, because I do know that when you're starting the home buying process, the part that everyone despises the most is the financing. So hope this gave you a little bit more insight. Again, this is Zaneaestermarie with Metro Brokers. Enjoy your day and be great.